Good morning, everyone. Happy Wednesday, May 13th, 2026. This is the pre-market morning report. My name is Joseph Blackland. Thank you for joining me. The headline this morning is the PPI release: yields spike as producer prices explode higher in April. After yesterday's hotter than expected CPI, driven in large part by energy, but seeing some contagion into service costs, this morning's producer price print for April was expected to show a major surge in annual wholesale inflation. Keep in mind that the crude oil price is still relatively low given the backdrop of the worst energy crisis in history, so the energy component of the PPI and the CPI may be underrepresented. With the eighth straight monthly increase, PPI rose by a massive 1.4% month over month versus 0.5% month over month expected. So it's up about a percent from the expected. My grocery bill is not up 1% month over month. The biggest month over month jump since March 2022, it's around the Ukraine war start, lifting PPI by a stunning 6.0% year over year versus 4.8 year over year expectation. That's the hottest PPI year over year since December 2022. Here's a couple of charts. This is on Zero Hedge. You can check this out. This is the title here. Yield spike as producer prices explode higher in April. Very easy to find. Services and energy saw the biggest rise, of course, energy inflation, while construction costs actually deflated very modestly. Core producer prices spiked 1% month over month, more than triple the 0.3 expectation, smashing core PPI year over year up 5.2%. Also the hottest since December 2022. The inflation was a problem before the war started. Now the inflation is starting to really accelerate now that the war has been going on for about 2.5 months now. And finally, one could argue this is as bad as it gets for the energy component as oil prices have stabilized. Yeah, they're stabilizing near $100, but the Strait of Hormuz remains closed, and it is expected that it's going to remain closed for just a little bit longer with the acceleration of the military activity and the tensions on the rise. They cannot work out a deal. There's always talk of a deal. There's talk of negotiations. There's talk that things are going to get better, but nothing ever really materializes. We'll cover the major headlines here in just a second when we're done with this article here. But of course, the pipeline of those energy costs is perhaps only just starting to trickle into the rest of the economy. Yes, the energy effect takes about 3 to 6 months to fully realize. So the damage that's being done right now in the energy market, we're not going to fully realize for another few months. PPI triggered a spike in 2-year yields, so the 2-year yields spiked, so that means bonds are going down, yields are going up, so bonds are being sold, debt is being sold, yields are going up, that makes it more attractive for other people to buy. Now back above 4% at their highest since March, with the market now pricing in a 50% chance of a 1-rate hike in 2026. The rate should have been hiked multiple times long ago. These modest rate hikes are just to really stop the total runaway inflation in the future, but the inflation is going to run away anyway. There's too much debt. There's 40 trillion recorded debt. The experts are insisting that the debt can be inflated away via, other mechanisms, and that it's not that big of a problem. Debts and deficits don't matter, that they absolutely do matter, and we're going to see why they matter as we get into the later stages of this inflationary debt cycle that we're all locked in right now. So, it appears that any chance of Warsh cutting rates, as per Trump's expectations, are off the table for now. Warsh is going to be put in there. They did a vote to give him a 14-year term, I think, and they're going to now vote on his chairman status. So Powell's on the way out, and Warsh is going to replace him. Finally, there is perhaps a silver lining from this ugly PPI report. Other than airfares, which rose 3%, the components that feed through the PCE inflation were pretty tame. Portfolio management fees dropped 2.4%, and the various medical care components showed a maximum rise of 0.3%. This may mitigate the impact of the report, but it is still hard to totally ignore the risk that inflation becomes a more pressing concern moving forward. That is the PPI headline article. Let's see what the futures are doing right now. The crude oil is at 102.50. Crude oil is eventually going to explore some higher prices here. It definitely looks not bearish, and we should be able to see 115, 125 pretty soon. The market is, of course, on the all-time high with a record rally, the strongest rally in history. I'm starting to think that this is a little bit more serious than just the AI trade. There's definitely something else that is going on here. AI is the reason that is being given for the tremendous performance of the stock market, but I actually think it has more to do with the record inflation and debt and the coming shocks of the energy crisis that are going to play out here, which manifests itself in the form of much higher prices. And the market is a price. So if prices of everything are going up and the debt continues to build, then we may just see this thing go up forever. There doesn't seem to be any end in sight. Now, if they were to hike the rates enough to actually curtail the rampant inflation that is running amok right now, then yes, the market would come in, the dollar would strengthen, we would see prices go down. But there's no real incentive to stop the inflationary spiral because it benefits the top players in the industry that have the most holdings. It hurts everybody else. So the inflation that hurts the everyday average person is actually beneficial to those at the top. So there's really no incentive to change. The NASDAQ is at 29,250. We're probably going to hit 30,000 soon. This thing's rallying on average several hundred points a week. So within a week, we should be at the 30,000 mark. In another couple of months, who knows? Maybe we'll be at 1 million in the NASDAQ. The gold is going nowhere, 4690, 4700 area. So gold is doing what it's supposed to do, actually, which is to store value and not move so much. So gold is behaving less like a speculative risk asset at the moment. The gasoline is still near 370. The gasoline's not going down. It's not going to go down anytime soon. We are going to be paying more at the pump for gasoline, and that is even if we can get it. There may be a situation where things get so out of control to the point where you cannot get gasoline at any price. Europe is running out of jet fuel. I think they have about 5 or 6 weeks before they completely run out of jet fuel. They are completely dependent on energy products coming out of the Persian Gulf, and there is almost nothing coming out of the Persian Gulf right now. If we go back to our Hormuz deficit clock, I've made some improvements. There were some metrics there that were incorrect yesterday, so I've corrected those. And we have today's date here. This has been going on now for 74 days, 13 hours, 35 minutes, and 58 seconds. The total barrels of crude oil lost since the Strait of Hormuz has been closed is estimated at 969,368,000. We're missing 13 barrels a day, 150 barrels a second. Daily demand is 104 million. We have effective supply 91 million. 12.5% of the supply of crude oil is currently missing. I started this about the hour. So we've lost about 7,000 barrels this minute. We've lost 308,000 barrels this hour almost. We're going to lose 91 million this week. This is now 2.15 times The worst crisis recorded in history, the Arab oil embargo, which removed 450 some odd million barrels of crude oil from the supply in a several month period. Inventory and reserve status, I updated this section. So now the IEA coordinated release to mitigate the damage of this is 400 million barrels planned over the next couple of months, of which the United States is responsible for 172 million. So now this SPR remaining metric right here shows where the SPR is right now at 388 out of 415. 415 is the figure where we started the war with. And we can see that this pledged 172 eats into this reserve by about 41%. So there's a planned release of 41% of our strategic petroleum reserve. We have roughly 400 million barrels in there. To give you an idea, China's got about 1.2, 1.3 billion barrels in their reserve. So they have 3 times as much as us. They can last much longer in a severe crisis than we can. Vessel traffic in the Strait is at about 5%. So 95% of the traffic that usually goes through there is not going through there. The total SPR draw so far is 22.3 million roughly. We're releasing about 2.3 every week. The max draw, which is how much we could actually extract out of there at any given time, is 4.4 million barrels per day. So in a really, really bad crisis, yes, we have reserves, but they can only be extracted and distributed at a certain rate. We can't just flood the market with supply. This is the problem that a lot of these shot callers are going to run into in the future, because every other problem has been met by simply putting digits on a screen and printing a bunch of money. You cannot print gasoline and crude oil, and there's going to be a fertilizer and crop problem. I don't think they're going to be able to print fertilizer and crops either. So this is going to be a major issue, because the normal method of problem solving that's been employed for the last couple of decades is not going to work here. Distillate stocks, less than 100 million. I'm going to use the average as the comparison. So this is the 5-year average right here is the marker. And then this is where they're at right now. And then this is the all-time high in distillate stocks, about 145 million. So distillates are down. Commercial crude sits at 453. They have released some commercials already around the world, but this is what is remaining in the commercial crude stocks. Gasoline stocks, 215. The average SPR draw per week, I said before, is 2.2. The average gasoline draw per week is 2.5. The 4-week demand for the products, which is all the products, distillates, jet fuel, gasoline. So it's going to be 20.3 million barrels per day. That's up 2.6 year over year percent. Gasoline demand 4-week is 9.0 million barrels per day. A 1% increase year over year, nothing major. Average prices at the pump for regular $4.45. I've seen them as high as $5 around here in the Midwest. In California, it's much higher. In other parts of the world, it's a little bit even higher than that. There's actual shortages in other parts of the world. In other parts of the U.S., the gasoline is actually cheaper. So 5.64, 5.64 for diesel. I would like to point out that even though these are elevated, they're not totally obnoxious, but the gasoline is up $1.30, which is up 30% year over year. And the diesel's up 61% year over year. These are massive increases on a percentage basis. The war premium analysis synthetic fair value model section is the same with some slight changes. We started at 65. WTI, this is yesterday's figure, so this is 102. Fair value for the Goldman estimate changed. It was at 149 yesterday. It's at 160 today. And the reason is because I did some more digging on the Goldman estimate, and Goldman was projecting a 10-week duration for the Strait of Hormuz closing. So it's now 74 days. 10 weeks is 10 times 7. That would be 70 days. So the Goldman model has run out of time. So the best and the brightest in the industry came up with a model that this would last 10 weeks, and it's already past the 10-week mark. Excuse me. So if the best and the brightest people in the industry came up with a model and that model's timeline has run out, that means that not even the experts know what's really going on here. So we are now officially in uncharted territory. The 52-week high is 117, 118. The discount to the fair value right now, where we're trading 102, is $58 a barrel. So the market is potentially underpricing the crisis by $58. And if the current price is 102, that would indicate a potential lift in the price over the next couple of months to the tune of about 50%. That would put the war premium at $95 a barrel. I went through the war premium components. We have physical supply shock, cumulative inventory depletion that needs to be restored. So as soon as it comes back online, they buy up a lot to refill the stores that they depleted during the first crisis. We have refined fuel stress, distillates 11% below 5-year average. Diesel 564 a gallon. Products stressed harder than crude. So the products themselves are being stressed harder than the crude oil that we make them out of. For example, the Europe running out of jet fuel in 5 or 6 weeks dilemma. Tanker logistics insurance. This has to do with the shipping and maintenance and insurance of all this stuff as it transits from one place to the other. The duration and mine clearance lag, the strait is mined. It's a complete mess. It needs to be cleaned up once the war is over. And that's once the war is over. We could see that from the headlines, the normalization of the war absolutely continues. So let's just take a couple of moments to read this. Bessent's suffocating Iran regime strategy materializes in Karg Island satellite imagery. So that doesn't sound like the war is winding down. Iran specifies 5 demands to restart peace talks with U.S. This may be a little embellished, that they may have just, given us a list of demands to work with, and then, the editors added on this little to restart peace talks with the U.S. I'm not going to get into this. I'll read this later, or I'll have, Gemini read it later. Trump mulls Operation Sledgehammer if ceasefire collapses. This is completely misleading. The ceasefire lasted a few days, and then Israel continued to attack Lebanon, which violated the ceasefire, and then Iran interpreted that as a violation of the ceasefire and then said, well, what's the point? So, but Iran has rearmed. So nothing, they're trying everything that they can to give the impression that the war is not going to continue and that things are going to get better. That is just absolutely not the case. Trump is on his way to China to meet with President Xi. So futures, yields, and oil all rise as Trump arrives in China. That's the headline there. China's definitely going to talk to our leaders about what's going on, because about 70% of their oil, as I understand it, comes out of the Persian Gulf, and they are suffering greatly as a result of this. So that does it for the articles there. I did pull this one. This is a very interesting article. You should read this, From Fuel to Food, The Bite of Stagflation. It very succinctly describes the interdependency of everything else on energy. So the energy market is extraordinarily important. Understanding the energy market is the key to understanding how the global economy works, because it's the lifeblood of everything. Shipping, and we turn the lights on, and how we fly from one place to the other on business trips. This is all a downstream. This is energy, that we're using energy to live and operate in the modern world. So the fourth CPI print of the year delivered exactly what Wall Street ordered, a beautifully airbrushed 0.6 month over month, while year over year inflation came in at 3.8%. Just a tiny unexpected upgrade from last month's 3.3% increase. Apparently, inflation is only transitory when you zoom out far enough. Underneath the soothing headline theater, food inflation slowed from its fastest annual surge since September, only to remain the hottest since November. And that's before fertilizer shortages begin turning grocery aisles into luxury boutiques. Meanwhile, energy prices bounced back to their highest yearly increase since November 2022, but nothing says price stability quite like paying more for literally everything that moves. Welcome to the opening act of Inflation Wave 2. Once fertilizer shortages and energy shocks fully leak into the data, the 3 to 6 month lag effect that I described before, consensus economists may finally have to retire the word temporary for good. So this is the graph that they have for contributions to the CPI year over year percent. Everything is itemized. We have all items: core food, energy, core goods, core services. This really is a very generous chart. And by generous, I mean that these metrics seem rather low. Energy is up 1.1% year over year. That's not what my clock says right here. I can see right here from the data that I'm looking at that the year over year increase in energy is 29% in gasoline, which is what we all use to put in our cars, unless you drive a Tesla, of course. And that the diesel is up 61% year over year. So I don't know how, I don't know where they get these numbers from. Maybe there's some magical calculation that I don't know anything about, or there's some, sophisticated method that they're using that is just beyond the scope of my understanding. Core goods 0.2%, core services 1.9%. Services that have really gone up. I mean, I've noticed that anything that you need to do, like if you need a car repair or if you need some health repair or whatever it is, that cost is up way more than 2% year over year. Core CPI delivered another thrilling episode of nothing to worry about, 0.4% month over month and 2.8% year over year, conveniently landing just above forecasts and last month's reading. Because apparently inflation persistence is now considered a sign of economic resilience, the narrative surrounding everything keeps changing and changing and changing to make everything sound like everything is awesome all the time. The real star of the performance was core services, the 76% of the basket heavyweight that policymakers keep insisting is normalizing. Instead, it quietly accelerated to 2.48%, its highest level since September. But don't worry, we're assured this is all perfectly manageable as long as nobody looks at the trend, which is up and 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 up. And it's going to keep going up. Probably going to keep going up forever for the foreseeable future. Translation: inflation is behaving impeccably right before fertilizer shortages, energy spikes, and petrochemical supply chain chaos arrive fashionably late to turn soft landing forecasts into collector's items. Enjoy this brief moment of statistical serenity before the second inflation wave starts surfing straight through the consensus narrative. I wonder what story they're going to come up with when the energy shock fully descends upon the market. Crude oil may be trading a whole lot higher, and even if we can afford the gasoline and jet fuel, we may not be able to get it. That is the backdrop of the current environment that we find ourselves in. It's going to be very interesting to see how this plays out. I am expecting that sooner or later the energy market price is going to freak out. They're really going to have to try really hard to prevent this thing from continuing to go up, given the fact that the war is definitely not going to stop anytime soon. That will conclude today's morning report. I'm going to try and get some more script demonstration videos ironed out. Connections seem to be a little bit better, and I'm looking forward to more strategy guides. I've got a couple of strategy guides that I did on the Asia Market Open. Check those out. Good luck out there. Make sure that you prepare in the future for much higher prices. You can do this by cutting your costs and looking into purchase, maybe some precious metals that should store the value a little bit better than the American dollars that are evaporating right in front of our eyes. And, if you cannot afford metals or risk assets, buying some extra food and or water, and maybe getting a garden going would be a good idea, as prices are definitely trending higher. It doesn't look like they're going to stop anytime soon. Until the next episode, you guys take care. Thank you for stopping by. I'll talk to you later.